Hello and welcome to Fidelity Connect. I'm Pamela Ritchie. A broad-based market pullback is unfolding worldwide. The rollout of Trump's tariffs has investors worried about the path forward. Now, high-yield bonds and other credit assets have generally provided risk-adjusted returns for investors, greater ones than others in moments such as this. And our next guest is going to take us through how he's been navigating the landscape to help provide investors with a good cushion. Might now be a good time to take a look at high-yield bonds. And which strategies ultimately is our guest using for today's market cycle? Joining me now to discuss what's shaping the global bond landscape and where he's finding opportunities is Fidelity Portfolio Manager, Peter Kahn. Great to see you again, Peter.
Great to see you too, Pamela.
And
thanks for having me.
Days such as this, we are very grateful that you're here in the chair and ready to share some things with us.
Well, surely there's just a few things to talk about.
There's just a very short list. We'll be through this very quickly. Okay, you and I spoke, I don't know, a couple of days ago, and credit spreads were in a very different place. We've got the 10-year sort of hovering around 3.9%, the yield. Things have come off significantly, and we know why things have changed.
Yeah.
When you watch credit spreads change like this, just sort of take us through what goes through your thinking.
Yeah. Well, typically we'd be, rubbing our hands together and looking for opportunities to take advantage of this were it not for the extreme level of uncertainty that accompanies moves like this. We've generally been, in an orderly credit market year to date. Secondary markets have been, open and functioning. New issue markets have been open and functioning. Credit has broadly outperformed, equities year to date. But, an escalation in a disruptive fashion of the tariff war that's been unleashed will clearly visit our asset class too at some point in time if it continues. So, it looks like a better balance of risk reward with credit spreads in the markets a little bit wider and high yield spreads out to about 400 basis points. We're rapidly approaching the historical average level on spreads, and yields are a little bit better than the historical average level. So, this is probably a good time for investors to, if they can take a deep breath, sit back, think about things with a cool head.
And a slightly longer term.
Slightly longer term horizon. It's an excellent point in time to start, considering buying an asset class that generates a healthy degree of income and produces a total return. Income in the high yield market at the moment. The yield on our index is approaching 8%. And with treasuries and other forms of sort of risk-free deposits having fallen materially in the last 6 months or so,
like
it
all
looks
of your savings accounts, GICs,
Yeah.
that moment's over.
It is.
Yeah.
It is. May those days come back again at some point in time when skies are blue and growth is great, and the average kind of rate on some very riskless product is mid-single digits again, but we might not see those times for a while yet.
It's fascinating. I mean, within the fixed income world, high yield will trade more like a risk asset. It's often paired with the equity markets in terms of its reaction and how quickly it can move around. Is that the case right now?
It is. It's become, having been fairly resilient and really just sort of shrugging off all the volatility in equities in relative terms. The last couple of days are a little bit more of a quake. So we're going to be more correlated with equities for a brief period of time. But correlation on the asset class over the longer run is about 0.6, 0.7. with the equity markets, and it's sensitive to growth, right? I mean, most things in the risk asset world are sensitive to growth, but the nice thing about the U.S. high yield market is that it's got quite a lot of different opportunities for diversification within there, some of which are quite defensive and are good ports in a storm.
So give us a sense of a little bit of what is within what you manage, to what extent, what the universe is. So how much of what you're managing is in fact high yield? Do you have room to add in other things at moments like this or other moments?
Yeah, we do. The fund range that we manage has a reasonable degree of flexibility. So for our flagship U.S. high yield product, we need to be minimum 70% invested within U.S. high yield bonds. So there's a reasonable degree of freedom for us to be able to diversify. We do that to have a liquidity cushion. We do that to take advantage of anomalies when they pop up in the investment grade market or in emerging markets credits very selectively in our space when they look like they're offering a real sort of juicy excess return relative to the same flavor of risk in high yield. For us, that's a moment to pause and consider whether we should add that to the portfolio.
Tell us a bit about the high yield space right now. If you think, it seems to be, I think there's still a thought that it's high risk, has a high interest rate, has a high yield on it because it's risky. How risky is it? Take us through what's in there and to what extent anyone needs to be worried in a moment like this, but at any moment.
Yeah. Well, I guess first thing to think about is the evolution of the credit quality of the high yield market. So, this is not our parents' high yield market, anymore. When it kind of came, into existence, and in its early years, it was a reasonably concentrated basket of low quality credits. But over the last 15 years, we've seen a massive, I don't want to call it an incursion or invasion, but arrival of a lot of higher quality balance sheets in our space. So
why is that? Just a matter of interest.
Well, some of it is, kind of financialization, the embrace of optimal balance sheet management in a low rate, low environment world when it, kind of made sense on capital markets theory to go ahead and lever up, and there was no real penalty relative to investment grade for, having a bit more leverage on the balance sheet. And sometimes it's old business models that are a bit stale, need a bit of a refresh.
What's an example of that? So Fidelity would have the ability to walk into a lot of very interesting rooms on this front.
Yeah.
Give us a bit of an example of sort of something that's stable but maybe a bit stale.
Yeah. So a couple of names that have found themselves in high yield for different reasons that are household names, at least in the UK, for example, Boots, the sort of
drugstore
pharmacists and chemists, of Walgreens Boots Alliance, which was cobbled together as a kind of global M&A roll-up strategy, taking advantage of low debt, but it's a lot of debt and not a lot of growth. Rising input costs. Lo and behold, they weren't able to sort of hold on to their investment grade status. That was never really the intention post the LBO because of those conditions I talked about earlier. Or you get big cyclical names that are household names. Ford Motor Company has been in the high yield space a couple of times. It's sort of on the edge of investment grade at the moment. But other auto manufacturers, given recent developments and their own problems within the business, like Nissan was recently downgraded into junk, became a fallen angel.
Okay.
As the parlance goes. So really the growth of fallen angels and the use of more financial engineering has been a big driver of more double Bs in our space. And naturally, more companies coming to capital markets with the evolution and deepening of capital markets over the last 20, 30 years has brought a lot of names that might have only relied upon a bank 30 years ago to say, hey, I can actually diversify my investor base and access, kind of different pools of capital by using the high yield market. So those would be the three big drivers of growth. Long story short, like double Bs, which are historically the probability of default for a double B over a 5-year window is 2.8% according to Moody's, right? For something that's investment grade or triple B, the probability of default is 2.1, 2.2%. So
it's not as big a gap as you think.
Yeah, exactly. There's, you can see some daylight through that gap, but it's not, an open wide window kind of thing. And, so that means that our market now has less inherent default risk from a mathematical perspective, at least, and, from an empirical perspective too, than it did, 15, 20 years ago.
Wow. Okay, that's fascinating. Take us through inflation. Inflation's bad long-term and in large swaths for everyone and in every market. There's also a bit of a sweet spot with inflation that some people in the equity markets will say 3% is pretty good. Is that work the same for high yield?
Well, there are elements of the high yield market that are super growth dependent.
Right.
So
Okay.
inflation is good for them, right? They issue, a triple C company comes to the market with very high leverage. So in our, one of our favorite stats, and we always throw out a bit too much jargon when we're talking about these things, but net debt to EBITDA is a very kind of standard ratio in our space. And you might expect a company like Ford, cyclical business, might have 2 turns of debt. A new triple C might have 6 or 8 turns of debt, according to the financial sponsor. When our analysts at Fidelity with
Get
their,
into it
with
and
their
take a look at
experience, and
themselves,
they take a look at it and see where the numbers are being kind of imagined a little bit. Sometimes the debt profile is even higher than that, right? So 8 to 10 times, which is just an enormous amount of leverage. Why are these things able to come to the market with that much debt? It's the assumption that they're going to be able to grow into their capital structures somehow, right? Either organically or inorganically, or they're a strategic business that a bigger fish is going to come along and swallow.
Right.
Sometimes that's true, sometimes it's not, and comes with a lot more risk than something that doesn't have that much debt and has actually cash flows and assets that it can if it needs to on a rainy day it can divert those
right.
to make sure that that creditors don't come knocking at their door. There's not that much cushion for a lot of these weaker names in the space, but so they're your to answer your question properly, they're your growth play.
So it works well for some of those.
It works well for some of those, and there's some cyclical sectors in our space too. Basic industry, which incorporates chemicals and metals and mining, auto space, and other sort of cyclical consumer discretionary stuff. There's a lot of other household names in high yield space in retail as well that will be a source of volatility in the current environment.
Okay, so what do we do with all this vol? It's extraordinary, actually. I mean, in some areas it's holding a little bit better, but volatility, business leaders, we think, are probably making decisions because they have to. Tell us how you kind of, I guess, calm everyone's fears a little bit about the vol environment.
Yeah. So, I think we've have the benefit of experience within the team, which is great, right? I mean, this is not, I don't want to be too facetious or flippant, right? But it's not our first rodeo, so to speak. So
going through
having had a team and an institution with the kind of embedded institutional knowledge of having ridden through some of these volatility spikes, and whether they are to also borrow another unwelcome term that's returned to the parlance in the last couple of weeks, transitory, and some which are a little bit more kind of structural. To be able to step back, calmly assess, do the scenario analysis. What's the impact? Where are we? What's the likelihood that we go down, this path or that path? To be able to do that in a calm and measured fashion, even as things are getting volatile, is important for any investor, and very important for us here at Fidelity. And that's where it kind of comes back to thinking about what do you do in an environment like this in a high yield fund. First things first, right? You want to make sure you've kind of trimmed the sails, so to speak, and always reassessing and rethinking, challenging the analysts and the rest of the investment team to say, hey, this was the investment hypothesis for company ABC 3 months ago. The world's changed.
Right.
Is that still the case? Can we rely upon that? Or are there things that we need to reconsider? And obviously those are all happening in real time. Even more important than that, right, is preserving portfolio liquidity. So coming back to your earlier question about what's in the fund and what else can we do? It's super important for us to always make sure that we're maintaining a liquidity cushion in the funds, right? We provide daily liquidity to investors, but we also want to be in a position where, if things kind of go bump in the night, and that creates an opportunity for us, that we can stand at the ready to take advantage of those, without needing to disturb the rest of the asset class mix, because the temptation in a super volatile market, what you might expect is people see things, kind of flying around from left to right between, breakfast and lunch, and then back again, between then and the close, is to say like, ooh, it'd be great to get in there and trade that. The issue is that that can be quite expensive over time, and you don't necessarily want to have to rely upon selling something to fund something else when volatility picks up. Right?
Yeah. Do you think, Peter, that this is a reordering of sort of the global trade system? I mean, it appears that might be the goal. What are your thoughts when you're looking at this?
Well, that's the stated intent, right?
Right,
and,
it is the stated intent.
Kind of the debate and the assumption, the facile assumption, I guess, amongst market participants has been that, back to the old dynamic of, listen to what he says, but don't take it seriously. Time and time again, it's sort of promises made, promises kept that's being delivered. Yeah. If you can filter out a lot of the sideshow of what's going on, so there seems to be a clear vector there, right, and a clear intent to restore an economic model or create an economic model that is rather different from the one that we've been operating in for the last kind of 20, 30 years, or really in the last 50 to 80 years, right, as the world's grown and incorporated more trade. So yes, there is in my disclaimer, right, these views are my own and not Fidelity's, but I am a history student by background, so I think it is rather interesting, and that we are at a sort of socioeconomic inflection point.
Well, the history books often talk about what really drives a reordering, sometimes worse things, but a reordering is often the indebtedness of an economy that will sort of force a change. Do you think that that's part of what's behind these massive changes?
I think there's no doubt about that, right? And if you stop and think about it, a very wise and insightful market participant and commentator that I follow.
Who will follow him? Or her?
It's a former trader from Goldman Sachs who writes a newsletter on a monthly basis to those he used to know in the market, and he writes his letter under the moniker of Macro Eagle. Okay. And he's also a historian, right? So maybe it's an affinity thing. But if you trace it back over the years, with the disruption that was unleashed and the indebtedness that's grown since the financial crisis, was really the spark that kind of triggered the populist movement that's been developing, and this has been going on for now. 15 plus years, and
same as the low interest rate cycle.
The forces that I think they've been exacerbated by that now, right? Because the perception was like, there was a bailout, debt increased, so sort of socialization of burden sharing, if you will, with the profits flowing not necessarily equally. Yeah. That's the message at least, and more people have latched on to that message, and the message has been refined, and since then debt in the system has only grown, and it's now grown to a level that's just frankly unsustainable. I mean, agree or disagree with what the U.S. administration is trying to achieve, there is a point there to say, with debt to GDP north of 100%, and with a deficit running at wartime like levels, that's not sustainable and affordable, and it's just a question of who's going to pay the price for that. And it's clear that their constituents don't want to sacrifice their entitlements and benefits. So the cost needs to be covered somewhere else.
Right. Yeah. So some of that really kind of comes into it. It's fascinating. I mean, to what extent is this about some fiscal stimulus that will come, in the form of, we know about the tax cuts, we know about deregulation. These are all the things I think a lot of investors are hoping come soon. But At this point, is there anything that can be done fiscally? It sounds like you're saying no.
Well, I think they're clearly going to try to get the tax package through, but effectively, what's just been announced this week is one of the biggest tax hikes in American history. Right. So, and also note that gone during in the election and in the run up, the sort of interregnum between election and inauguration, there was a lot of talk, as there was in the past, about how it's all those nefarious foreign economies that are going to be bearing the burden of tariffs. They're going to pay for it. Well, guess what? It's the American consumer that's going to be paying for the tariffs out of their pocket. Yes, there will be pain along the food chain or along the supply chain that ripples through, but that will be managed.
Well, and the pain is being priced in. I'm going to ask you about the Fed next, but I mean, in terms of a recession being priced in, or how the Fed might have to respond to that one way or the other. I mean, we're watching that be priced in, are we not?
Yes, we are, right? And I mean, you referenced the 10-year rate at the beginning of our conversation. The front end of the yield curve has come, even farther down over the last, kind of 5-6 weeks. We're now looking at 2-year and 5-year treasuries at 3.5%, and more than 4 rate cuts now priced into the forward curve, maybe even 5 as we speak. Just as we're talking here, which in a normal kind of Fed put scenario, you might think is reasonable. There's all kinds of additional complications with the Fed having been painted into a corner now by the kind of tariff impact on inflation, which they've kind of dusted off that terrible transitory term again to refer to, which in a textbook sense it is, and it should be a one-off thing. But after so much pain has already been borne by households on that front, maybe it's the proverbial last straw to see the inflation rate, by our own modeling and many others too, should be up by 2% at least on the back of the tariffs that we've seen.
Interesting. 2% on top of where we sit now.
Yeah.
It should be up by that.
Yeah.
So the Fed has, we're doing this sort of dual mandate. We got the jobs report in this morning, which actually didn't help.
Which gives them even the limits.
Quite good.
Yeah.
Higher than expected on the U.S. payrolls. I just wanted to ask you, when you went back to sort of where the 2-year has moved to and the 10-year has moved to, just remind us of where the high yield market sits. So they're roughly, what is the duration of most of those securities? Yeah,
so the duration of the high yield market is a little bit less than 4 years. And the actual sort of effective duration, right, the empirical duration is more like, kind of 2.5 to 3 years. So only 15% of our market matures beyond 8 years. The bulk of it is coming due in the next 3 to 5 years. So as you can see, there's a little bit of short cycle refinancing risk there that also amplifies the default probability relative to investment grade, which has got a duration of, say, 7 years.
Exactly.
Okay.
Right.
So, but that's actually one of the redeeming qualities, right? It's a feature, not a bug of high yield for investors, because there's a very low sensitivity to rate volatility, which has been very, very high over the years. And on a sort of a risk-adjusted basis, you're getting 8% yield in an asset class with 3-year duration, which means in simple mathematical terms, it takes an awful lot of a big move in either yields or credit spreads with the all-in yield on the asset class at 8% now. For you as an investor, Pamela, you buy high yield today, if in a year's time rates have backed up by 100 basis points and spreads have widened by 50 basis points, you're still in the black from a total return perspective.
Yeah, it's so interesting with a yield, you say, of sort of 8%. Yeah. So that's a very different place than when you're watching what's going on in equity markets right now. Tell us just a little bit more about sort of what your asset class is meant to do in time. Let's take it to recession, because it is what's being priced in right now. Yeah. So if you need somewhere to park that's as safe, maybe not as safe as gold and sometimes the dollar, though the dollar is doing some strange things as well. Tell us about this asset class, where it sits in terms of those that want to sleep mostly well.
Yeah. It's obviously not as sleep at night as government bond or a bank deposit. Slightly more sleep at night is investment grade credit, which has got duration risk, but it doesn't necessarily have default risk. Next in the food chain comes high yield, which has got a combination of default risk and very low duration risk. And with the overall, again, the profile, the quality of the market in high yield has evolved to investors' benefit over the last decade plus. So we've now, with a little more than 50% double Bs, in a recession, spreads are 400 today, right?
Yeah.
The average spread in historical period of 20 years plus is more like 450 basis points. If you start talking about a proper recession, then you're looking at spreads in the olden days, heading to 800 to 1,000 basis points. That was when double Bs were 35, 40% of the market. Okay, so if you're looking at a milder recession, so not a financial crisis, and you're looking at an earnings slowdown, which is what we're pricing in the equity market now, from double digits to now low single digits, and maybe even negative, right, in the down case scenario. The cash flow profile of 80 to 90% of the high yield market is more than sufficient to ride it out for a little while. There's a tail, and that tail will move from performing high yield into stressed and distress. So the dispersion between that tail and the core of the asset class should rise. It's begun to, even before the noise was turned up this week. But it could go, it's still only, let's say, halfway to a pure recession pricing. So within high yield, what we're doing and what we have been doing over the last 6 months has been, making a little bit of hay while the sun shines to move the portfolio up in quality and own more of that stuff that is, in theory, immune from default risk. You can in our space, we're always glass half empty, right? Being fixed income people, you never say never.
Realistic, some would say.
Well, some might say you never say never, but kind of barring systemic financial crisis, we're looking at space now in double Bs, in particular, where the combination of the spread and the yield is getting a lot more enticing.
Very interesting to hear what you are calmly looking at as markets zig and zag all over the place. Thank you for joining us. Do you have any final message you'd like to share with investors who, rightly might be concerned and looking for places to hide?
Yeah. Well, I mean, it's always a bit, scary when things start getting, very volatile. So I think the key thing to remember is that, we're investors, right? Investors with a horizon over the cycle that's not, from here to this afternoon, from here to tomorrow. We're thinking about how we can create value over much longer periods of time, 1, 3, 5, 10 years. So I think it's always important to kind of maintain that perspective, to make sure that you kind of keep your eyes and your mind open. And if you had some money set aside that you were looking to invest in riskier stuff, you would definitely, the kind of moves that we've had in the last couple of weeks are eye-catching enough such that you should really start considering about whether it's a good time to capture some value for the long run, but you need to be eyes wide open. So fixed income is always been a beneficiary when in historical times when things get tough.
Yeah.
Your preferences within there are all going to be ultimately personal, but when it comes to an 8% yield with a volatility profile of 35 to 40% of the equity markets, making a real return somewhere in the mid single digits on a 1 year horizon against the unknown in riskier asset classes is going to attract a lot of attention.
Fantastic. Peter Kahn, thank you so much for joining us on such a momentous day. I think we all needed a dose of exactly what you had to say there. Thanks. Well, have a great weekend.
Yeah, Pamela, thanks very much for inviting me on. It's always a pleasure to chat about things as they're unfolding, and wish you a great weekend too.
Thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.